And basically going over risk and cost of capital in chapter 9. Here, what we're really focusing on in this chapter, honestly, just the first two company cost of capital, measuring the cost of equity. These are the two pieces that I want to go over today. And essentially, what is the cost of capital of a company? I'm sure you guys have seen this before, and we're just looking at it one more time. It is, a theoretical way of finding out what is the basically cost of financing for a company. Now, of course, a much easier way to look at this, I mean, from a perspective of something that's going on in reality, not theoretically, is what is the company what is the company paying on its new bond issue? This is its risk of debt right away. You could see the risk of raising capital. You know, um, you could see the risk of capital of a government also. I mean, what's the yield to maturity on U.S. bonds? I think the 10-year bond right now is at 1.6%. What is you could look at what is the risk of any company that you're interested in right away. Now, equity risk is much more complicated because um, it's not like we're looking at this to see right away what is the risk behind an equity. Now, when when for example, Airbnb is being valued, I think we talked about it as being valued about 25 billion. You could see, for example, what is the expected return for them per year to get to the earnings that allow such a valuation, because that is where the market is valuing them. So they need to provide that kind of return in order to get to that kind of valuation. But it's kind of done in a reverse way, where investors do the valuation based on what they know, and that sets the future equity price anyway. So looking at this formula, just be aware, hey, this is the theoretical part, the CAPM model, but in reality, there's other factors. So that we discussed, it's just the yield to maturity on bonds, and the equity piece is basically risk-free rate plus beta times the market risk minus the risk-free rate. So basically, we're talking about what is the market premium on the situation, and we want to check and see how much is the beta adding. So basically, it's beta driven. Of course, this is, the beta is how closely the stock correlates to the market itself. So if it's more sensitive to the market, this cost of equity will be higher. And the market rate is basically how much is this, how much is the market rate for this particular market, in a way, as opposed to the risk-free rate is basically the rate at which everybody's in a way borrowing. So there's your 2-3% or something like that. That is risk-free, like U.S. government or something. And then market premium, the market, of course, will warrant a higher premium usually. So looking at an example, we could see, for example, if somebody's the WACC of a company, you could see the percentage that comes through the ratio of how much debt you have versus equity you have to the total value of the company, and this is the equity rate of risk, and this is the debt weighted risk, 7.5 and 15, and you end up having cost of capital of 12%. What does this really mean? Is basically your total cost of financing, and in reality, um, what should be kind of like your NPV or like your risk discount rate for projects that you're going to be financing. So bring all the way back to the previous chapters that we discussed, and this is basically the rate that you have to clear, because this is what your investors on average are expecting a return of, and this is what we calculate here.